Right, so let's begin every aspect of your financial planning. And today on the radar, first is insurance. And in insurance also, we'll help you understand what exactly is surrendering your policy. What kind of insurance policies can be surrendered, and what should be the reason behind surrendering your policy? Let's understand this entire concept. With me, I have Mahavir Chopra, founder, Beshak.org. Mahavir, good evening and welcome to the show. Surrendering a policy. Before I get into the technical aspect of it as to how to do it and what's the protocol, I want to understand what is this procedure called? You know, what do you mean when you say that I want to surrender this policy?
Surrendering a policy is basically terminating a policy or discontinuing a policy. You bought a policy, but you are probably not convinced with the policy, or for some financial reasons you want to drop out of the policy, is when you can basically go to the insurer and surrender the policy. That's what is called surrendering a policy.
Okay. So, Mahavir, this happens, Mahavir, this is an aspect of your life insurance policy, or we are also talking about general insurance policies here?
No, this is a feature that would be available for any policy that has a savings component. So typically non-term insurance policies in basically life insurance segment, typically those policies would have a surrender value.
Surrender value. Now, that's a term I really want to understand.
Right.
Talking about life insurance policies where we see the case of surrendering, they are really higher as compared to the other types of policies that we see around. What, according to you, could be a trigger for a policy holder to surrender a policy?
Yeah, so typically a lot of these policies are bought without a lot of research, and typically bought from friends or families, or let's say some other relationship, like probably a banking relationship. And after a couple of years, there are people who understand that, okay, this policy probably does not match the financial goal that the person has. That's one of the largest reasons why people basically surrender their policy, when they realize that the kind of returns that they're getting or the kind of commitment that they need to make is very high, is when they decide to basically drop out of the policy after knowing the terms and conditions later. So typically this is a case where people are unaware of the terms and conditions when they buy the policy, and later on they come to know, probably by talking to some other financial advisor or reading on the internet or watching shows like yours, right? So that is basically where people get triggered about doing a surrender of their policy. The other could be basically other specific reasons, where let's say there is a person who's not able to pay premiums. They bought a policy, but the commitment is very high. For some financial reason, they are not able to pay premiums. That could be another reason why people could surrender their policy.
Could mis-selling also be a trigger for surrendering a policy?
Yeah. So the first point that I mentioned was largely about there either being misbuying or mis-selling. Mis-selling is when someone has basically hidden facts from you and sold a policy to you. And misbuying is when you have been lazy and not understood the terms and conditions and just bought it in a hurry. In both these cases is where surrender happens the most.
Is there a period until when you cannot surrender a policy?
Yeah. So in case of typical money back policies, which are not equity linked ULIP policies, the typical time when you can surrender a policy is after 3 years of its existence. So if you surrender before 3 years, you can, but you will not get anything back. So your surrender value, which is the money that you will get back, is zero, and hence typically you can surrender a policy only after 3 years of its renewal and continuance. Right? In case of ULIPs, typically there is a lock-in period in a policy. Typically it is 5 years. And if you surrender the policy before 5 years, you can do it, but your money will basically move to another discontinuance fund, where the interest rate is a very hygiene 4% to 4.5% rate. And you will get the money only after the lock-in, which is basically 5 years. So if I've invested, let's say 3 years ago, I can surrender a ULIP policy today, but the money will move from whatever large cap, mid cap, whatever equity or debt kind of category that I had chosen, to a discontinuance fund, which the insurer will keep your money in and then return the money after the lock-in ends. So that's how a ULIP can get surrendered.
a surrender be denied by an insurance company if a policyholder approaches? And are there any grounds on which insurance companies can deny that surrender?
No, after the surrender period has started, which is basically in at any point in time, the insurance company cannot reject your proposal of wanting to surrender your policy. The only cases where you wouldn't want to surrender would be when, in the cases where you're not getting the money back or you're not getting anything in return back, and hence you would want to hold it. But insurers cannot reject your request for surrender of the policy.
Let's get into the calculation of figuring out the surrender value. Is surrendering a policy always a case of going into losses for a policyholder?
Absolutely, absolutely. So, if you surrender a policy, typically the kind of money that you will lose, depending upon the time you have invested into the policy. Let's say it's a 10-year policy and you decide to close in the 4th year or the 5th year, a sizable amount of money will basically get deducted and as charges, and you would be only paid the remaining money. Typically, it would be in the range of between 10 to 30% is what you will get back of the money that you invested. The idea behind this is that when these policies are built, they are built with the concept of lock-in, and they want to basically keep the money for that period because they are doing back-to-back, investments and commitments as insurers to, let's say, other investment avenues that insurers have, and hence this kind of a structure exists where an insurer, if a customer who has committed to pay for 10 years decides to drop off before that 10 years or 5 years or whatever is the lock-in period, then in that case specifically you will have major deductions. And like you rightly said, in most cases, in almost all cases, you will basically have a loss in surrendering your policy in case of money back. In case of ULIPs, the benefit could be that, let's say, if the 5-year lock-in has got over and you've invested in a ULIP fund which does well in the market, for some reason it has done great in the market, then you will get your paid up capital back, which is, you'll get whatever is the fund value back, obviously after deducting the regular charges that an insurance company would have for that particular product. So if you drop off or you surrender a policy in case of a ULIP after 5 years, you're typically paid the fund value. And that fund value, if it is higher than obviously the money that you've invested, then you could probably have a very small profit to a large profit, depending on the how the fund has performed.
What, according to you, is the procedure to, get this assigned by the insurance companies? What are the nitty-gritties and what's the protocol? Do you just have to go online and fill up a surrender form? You have to specify the reason why you want to give up the policy? What all is included?
Yeah, so surprisingly, none of the insurance companies I know have an online surrender option. You have to go to a branch physically yourself and basically do the surrender formalities. In this, you need to fill a surrender form. You need to basically give the original physical policy that you would have received. And there is a basic paperwork which is around KYC and giving your blank check, the cancelled check is required for crediting the funds, those kind of things. But yes, this is a face-to-face operation. You cannot basically do this online in most of the insurance companies I know.
So now, what all can you do in order to, secure yourself or maybe avoid coming down to this level where you have to surrender a policy? Is there any set guideline that you want to share with our viewers so that you don't land up surrendering a policy and go to the entire pain and also incur losses in any investment?
Absolutely. So the first thing is that don't buy a policy out of impulse, right? Just because someone is pushing you a product or basically selling you a product which you have not aligned it with your financial goals, just don't buy it like you're buying something in a grocery store. Like, don't pick up a packet like that, right? That's the first thing that I would say. The second thing is understand the financial commitments in these policies. Typically, these kind of policies will have large financial commitments. There could be policies which would require you to pay for 20 years. And if you don't pay for 20 years, there would be a significant drop, like what we discussed. In case when you drop off in between and surrender the policy, you will have significant losses. So understand that financial commitment. The other financial thing, commitment that you need to understand, one is understand how many years you need to make premium payments. you also need to understand lock-ins, right? A lot of policies will have financial lock-ins where you'll not be able to withdraw the money out. So when you're comparing a investment in such kind of products, you have to compare it and align with your financial goals. Are you okay with a lock-in? Are you okay with not being able to withdraw money out of these kind of funds for these many years? That is basically what is the product feature all about. The last and the most important is basically to understand the fund performance if it is a ULIP of that specific ULIP that you're buying, and if it is not a ULIP and if it's a money back or any kind of traditional insurance policy that gives you fixed returns or let's say with bonus, then please understand the internal rate of return that you're getting from this policy. Ask the financial advisor or the banker to give you in Excel an actual calculation of how much is that you're going to earn out of this product in terms of ROI. And if the return does not match with your needs today as a person, let's say you're someone who's 30-year-old, you don't need a product which gives you 4.5% return or 5% return, then probably you need to drop off at the beginning, at the source, and not after buying the policy like usually people are doing today.
I think that will be all. Thank you so much, Mahavir, for being on the show and helping our viewers understand all the aspect of surrendering your insurance policy. On that note, it's